We're navigating succession planning. This is the IssuesWatch podcast. Hi, I'm Don Meyer, Chief Growth Officer at the New Jersey Society of CPAs, and welcome to the IssuesWatch podcast. With tax season in the rearview mirror, many accounting firm leaders are reflecting on their next steps, including retirement. Succession planning isn't just about stepping away. It's about protecting the future of a firm, ensuring smooth leadership transitions, and maintaining client trust and operational continuity. As private equity firms show increasing interest in the accounting space, leaders must carefully evaluate their succession options to balance financial security with long-term firm stability. Here with me to discuss how to mitigate risk when there's a leadership transition is Alvin Fennell, Vice President and Senior Risk Advisor at Aon, and Stan Sterna, Aon Affinity's Accountants Risk Control Lead. Welcome, Al and Stan.
Thanks for having us, Don. Great to be here.
Thank you, Don. Appreciate the opportunity.
Al, let's start with you. How does a strong, proactive succession plan for small to mid-sized firms help manage professional liability risk?
Thanks, Don. Well, I think the key thing in regards to the question is, strong plan. I think the firms, will help manage professional liability risk by ensuring business continuity, protecting the institutional knowledge of the firm and mitigate any possible disruptions caused by the loss of, key personnel, key management member. I think a succession plan will allow the firm to identify key issues that may arise that would impact the firm's transition through the change. Another key thing, client service and communication would be better managed. Responsibilities are assigned and potential problems are identified in advance. So I think that's the important part, in regards to the succession plan. I think the plan should minimize disruption, outlining a clear communication plan with existing clients. As I mentioned, preserving institutional knowledge, that's key. You've got a lot of individuals that are leaving the firm that have key details around an engagement, around a relationship, just a sheer knowledge of the profession that needs to be assigned to an individual, and there's assumption of the responsibilities. Provide details around the client, so there's no surprises and chances for client dissatisfaction. And then, manage the firm's reputation, because I think providing a smooth transition will promote the firm's professionalism and reliability. That's kind of the summation of, what I think of, kind of the intent of that succession plan.
Just out of curiosity, what percentage of small and mid-sized firms do you think have a succession plan? I mean, I think they all know they need one, but would you say more than half, less than half? Because you deal with small and mid-sized firms all the time.
Based on, and I've been working with firms over 30 years, just anecdotally based on, my communication, less than half. Yeah. I think, the firms kind of go through phases. And you've got that inception, where everything is running wild, they're building internal controls, they're focused on, business growth, things of that nature. Then there's, after maybe 3-4 years, they're kind of, and Stan, you can jump in, they kind of level out, specialization, they're building kind of internal controls and responsibilities. Then they may grow into a point where they start, it become more of a regionalized entity. And I think that's when they start really thinking about, that succession plan and the next step as they phase into more of a mature firm. And they look at, whether there's, a merger or acquisition, new investment, how they're promoting, to the partnership level internally. I think that's when they start thinking about developing that plan.
Right. I think your number's probably accurate. We've been writing about succession planning and the importance of having a succession plan for probably 20 years at least. And yeah, I would say just again, anecdotally, without any hard data, I would say, yeah, it's less than half probably have a really solid succession plan. So Stan, one of the ways that firms that maybe don't have a succession plan or do, one of the ways they're adapting is through private equity investments. There's a lot of interest from private equity in the accounting space. So what risk management considerations should a firm consider when entering into a PE deal?
Yeah, thanks, Dad. So, it's certainly an exciting time to be an accounting firm, especially from the perspective of all the PE investment within the industry over the past few years. And some of the firms I work with large and regional and national firms. And, some of the managing partners are getting 3-4 calls or emails a day from suitors, potential private equity suitors, asking if they're interested. So it's an exciting time. And you're right. One of the main facets of considering private equity is to build your bench strength, to build an operational management structure or staff structure that's going to be resilient if somebody leaves or if there's an event that causes somebody no longer to be able to practice. So the way I see any firm diving into the private equity model or considering the investment, there's about 4 key considerations from my perspective. There's a lot of things, obviously, that individual firms are going to look at before they decide on an investment. But 4 things that I think from a risk management standpoint is something to consider. One is obviously due diligence. Like I said, there is an influx of private equity interest in the accounting firm profession, and firms are fielding calls every day about this. So, of course, doing your due diligence at the outset is probably the most effective way to mitigate any sort of risk that could be foreseen on the horizon. And that really means overall vetting of the PE firm to make sure it's a good fit for your particular firm. There are many, many, many private equity investors in the accounting space right now. And you want to make sure that you're partnering with one that understands not only the profession, but your firm and how it operates. I think another key point in conducting the due diligence, and this is more specifically aligned to a detailed analysis of one facet of how the firm is going to change with the infusion of PE. What is going to be the decision-making structure? Assess how the PE involvement might affect the firm's decision-making authority, particularly with regard to managing risk and establishing clear governance structures within the firm to manage those risks and compliance with regulations and law. Another thing is understanding what their operational strategy is going to be. Make sure their operational strategy also aligns not only with your firm's operational strategy and objectives, but also with your firm's culture of risk management. You don't want, with any new interest coming into the firm, whether it's through private equity investment or a merger or an acquisition of another firm, you want to make sure that the infusion or this new group coming in is not going to affect what has been hopefully a very successful operation, and something that is not only successful but also risk adverse. The 4th one is communication. We see a lot of issues with whether it's private equity or a new firm being acquired or whatnot. We see a lot of issues where there's confusion by the staff. And so to eliminate any of that confusion, try to be as completely transparent as you can with the staff at your firm. And that means, from my perspective, not only telling them about what's happening, we're considering or we're taking on private equity investment, but what it means for their specific immediate future. A lot of people are going to have questions about how does this impact not only the firm, but how does that impact my long-time career objectives? Is there chances for upward mobility? What might my position look like in a new ownership structure? I think the more you can talk those things over with employees, I think the more it's going to be just that much smoother of a transition if you accept either private equity investment or, some other structure in place.
Yeah, that's a great checklist. And with the NJCPA communications director sitting close by to me, I'm going to mention, I think that would be a great article. I think members would love to see that in print. So no, that's terrific. Thank you for that. So Al, let's go back to you. We've all seen the statistics on the number of baby boomers who are going to be retiring from public accounting firms in the next 5 to 15 years or so. So when a leadership transition is on the horizon, what risk mitigation steps should a firm consider to ensure that clients continue to receive a high quality service?
Well, I think, just to support what Stan was saying, I think communication is key. I think making sure the clients are notified of the changes. Transparency is key again. I think the worst thing in the world is to have a client be notified of a change through word of mouth or not controlled by the firm. I think it sets things up, for an expectation gap as a result of that change. And the last thing you want to do is have disruption where a client now feels that, they're forced to look for, another service provider. I think that, making sure that the firm has instilled a comfort level. And I think that's just a continuation of normal practice. Your everyday, providing of service to a client should just be supported by how you communicate change. And I think it's tied to, having an internal plan and an external plan. What are your clients, what is your staff responsible for in regards to managing that change? How are you going to utilize, and if you have that exiting individual, whether it be leader or key staff member, how are they involved in communicating that change? How soft is that transition? So again, I think it's informing clients proactively. Don't let the information reach the client by surprise. Explain the change and its impact on the client and who will be assuming the responsibilities and how will it impact the relationship with the firm. Make sure also the firm clients know who to contact if there's any question. Make sure they've got a comfort level and their response is key. And the other say, establishing a training program in regards to that transfer of knowledge. I think each client relationship is different. And I think that the succession plan should accommodate the differences in those relationships and how you're going to manage those small details that have built that relationship over time with that individual. And one of the other things is each identified risk or potential risk, assign an owner. Make sure someone is monitoring the firm's progression through that transition. If there's not an owner assigned to a project, it doesn't get done.
Right.
and you can't monitor the progress. So there should be a plan in regards to when you're checking in. What are the benchmarks? If there's any issues, what is the immediate way of addressing it? And then again, how do you pivot and monitor the progression to how things are doing well?
Yeah, I think that's a good point. If you say, well, everyone is responsible for, and then you fill in the blank, let's say communications, because you both brought up communications. If everyone's responsible for communications, then no one is responsible for communications. And
exactly.
Chances are it's probably not going to get done. And I think it's interesting that you both emphasized communications. And I think that's a good lesson for firm leaders that you need to establish that communication structure now before the change happens, so that you kind of get into that practice of communicating regularly and effectively and efficiently with your clients and with your customers, because trying to develop it on the fly when now there's a sense of urgency, that can be incredibly challenging. So I think that lesson about communications is a really good one.
And Don, I think it's important, and Stan can attest to this too, is, there's two ways of addressing it. I think, firm meetings, throwing that scenario out within the management team, if we lost a partner or someone, identified themselves as retiring, how would we handle that? Go through kind of that test in regards to managing that, and then creating that document around that scenario. Or if someone stepped in and said, hey, there's, we need to address this talent issue, and one of the ways of doing it is acquiring a firm, acquiring that talent. How would we go through, what would be the steps taken to go through this project? I think, going through those scenarios before they present themselves, so you've kind of built the muscle memory, is key.
And sometimes even admitting, well, maybe we don't have the internal expertise to do this. Maybe we look to the outside to find somebody who can help us out with this.
Yeah. Knowing what you don't know is one of the best ways to manage risk.
Right. And one of the ways to find that out is through, like you said, scenario planning. Yep. Play through some scenarios and see where you're missing maybe some knowledge or people or something like that. So Stan, what role do legal protections, insurance, and buy-sell agreements play in managing risk during a firm transition?
Yeah, Don, I would just add this disclaimer before I go into answering those. Obviously, you want to consult with legal counsel when you're drafting contracts. You want to consult with your insurance agent or broker with regard to any insurance needs. But, it depends on the scenario. If you're talking about a scenario where you're selling your practice to another firm, a well-defined, clear and concise sales agreement, which outlines the ownership transfer terms and everything else that's going to be impacted by or potentially impacted by the sale, is definitely the key. Some things to consider, language to consider, discussing with your attorney, and those buy and sell agreements are insurance for the acquired firm. How is that going to work? We're going to talk later about extended reporting coverage or tail coverage. How long, who's going to pay for the deductible? Who's going to pay for the premium if the acquired firm that no longer exists is going to have tail insurance, which they should. Records management. How are we going to transfer records to the new firm? Client transition and client consent is key. There's a lot of ethical rules that pertain to client consent when providing information. Just want to make sure that the client is aware of the transition and how their records and files are going to be handled. Completion of any work in progress, if there is any, of the acquired firm. That's a key point to address in any sales deal. Obviously, you're going to want to have language with regard to staffing. You're going to discuss potential employment agreements that may come into play. If anybody's leaving, you want to consider, are you going to have, because of the acquisition, are you going to have non-competes? Or are you going to have non-solicitation clauses? There's been a lot of backlash against non-competes. I think there's a little more leeway by the courts if somebody's a partner. What the courts are really trying to do is to protect people from being able to earn a living within a reasonable, under reasonable restrictions. They can't be unreasonable. So there's been a lot of backlash. So there's a lot of states that still have bans on non-competes. Talk to your lawyer about your state and whether they have a ban. Generally, a lot of firms will decide on non-solicitation of clients clauses for anybody that's not going to be going to the new entity. The responsibilities and role of each party in the transaction, very important, sometimes overlooked. And then an opt-out clause, which provides the purchaser to sell an option to change its mind at some point before the deal is consummated. With a buy and sell agreement, where you are setting parameters for when a person retires or when a partner may or may not be part of the firm anymore, about outlining specific terms for they're selling their ownership interest in the firm as a result of a triggering event. It could be the estate selling it because of death. Death could be disability, could be a retirement. It's important with these buy and sell agreements that you have some key provisions in there that is going to, I guess, address some of the risk areas we've seen when people have maybe complained about the deal, or maybe the buy and sell agreement wasn't something that they thought was fair and they're disputing it. One thing is value, setting the value. Most partnership disagreements are a result of a dispute on money. It could be money owed to the partner. It could be the value of their ownership interest. So being very specific in explaining, okay, this is how the value is going to be calculated. This is how the value of your share is going to be determined. Are we going to base it on revenue? Are we going to base it on net income? Are we going to base it on some other formula? It is a key, because as I said, it's a primary dispute. I mean, you can just imagine most partnership disputes are either about control or they're about money. In addition to value, and it kind of correlates with it, is how payments will be made to the retired partner. Is it going to be, people are going to have to understand, is it going to be a lump sum payment? Is it going to be payment over time? Eliminating confusion regarding the money payout and how it's going to be calculated is extremely important in these agreements. Other very important provisions in a buy and sell agreement, you want to have restrictions in it that prevents the partner from selling to any outside entities. You want to restrict, obviously, the partner from being able to poach clients or compete against you, and take a look and talk to your attorney about restrictive covenants. And then obviously you want a defining triggering event that's going to trigger the provisions of the contract. And I would include any potential scenarios that when you're discussing it with your attorney, where a partner exits due to some unforeseen circumstances. Those are usually the situations where you have a lot of confusion. That's usually the situations where, if you don't have a proper succession plan in place, you'll be in things get, mistakes are made, work isn't done, mistakes that are determined by the person who is leaving. Sometimes they're put in a drawer and ignored. We see a lot of claims like that. So level setting expectations through the buy and sell agreement as to value, as well as other things about, what is a triggering event that's going to trigger these provisions, is important. Finally, a big risk when any important person in a firm leaves, whether it's a partner retiring or leaving for some other reason, is how it's going to affect your client base. How's it going to affect the clients that they're working with? One way is obviously communication with the client. We've talked about that, but some firms will have a structured written process in place, a specific for client relations, and that goes beyond just transferring the client to the remaining partners. It's about communication. It's about divvying up the clients based upon where you have the greatest bandwidth for that specific client industry, maybe the services you're providing, making sure that the transfer is a good fit for the firm, that it's with the right person. Staffing can be a focal point on a lot of risk claims, or a lot of liability claims, where clients or claimants will claim, well, you had individuals in here involved in the engagement that just didn't have the requisite experience. So It's not only important to have a body in place to pick up the ball if the person leaves, but the right body in place to pick up the ball if that person leaves. I know your last inquiry was about insurance, and Al, jump in at any point if I'm if you want to clarify or add anything to the conversation. So, specifically when I'm talking about insurance, for purposes of our conversation, I'm talking about accountants, errors and omissions coverage, professional liability coverage. One thing you have to understand is to what extent is professional liability coverage that you have with the firm, is it going to cover services that were done, prior services done by somebody who left, or maybe prior services done by a firm that no longer exists because your old firm has now been purchased and absorbed by a succeeding firm. Understand that professional liability claims can linger for several years, even after the service has been delivered. And it can linger for several years, even if you don't exist, even if you're now a member of a new firm, even if you've gotten out of the practice of accounting. So I think an important aspect to consider is whenever you have a significant change in your practice, like the ones we've been discussing, you need to consult with your insurance agent or insurance broker. And not only just any insurance agent or any insurance broker, but one who specializes in advising professional service providers, specifically CPAs and accountants, somebody that knows your industry and knows your business. If you retire, let's go and talk about different scenarios. So if you retire and your firm continues to live on, but you're retiring and leaving practice, make sure that the existing coverage that will continue in place will cover you for acts that you did before you left the firm. Generally, it should. If you're an employee of that firm and you're providing professional services for a client on behalf of the firm before you retired, and there's an error and omission, and the error and omission is alleged within the statute of limitations, the coverage will respond, usually, generally. You should, it's a caveat. You got to talk to your insurance agent or broker. If you're selling your practice, some firms that are buying the practice may take on your prior acts that you did before you left the firm, but that's generally not available. And generally, risk-adverse firms are going to say, we're not covering acts that you did before we bought your practice.
Sorry to interrupt, but Sterna,
Yep.
You bring up a great point in regards to that loss information. I think, if you're a firm that's being acquired or you're acquiring, make sure you check the claims history. That'll give you an idea exactly in regards to if there's any potential landmines there that may impact you in the future, because you're assuming the reputation of that firm. It's a blending of reputation. You're assuming that reputation as you become that new entity. Yeah. So, definitely inquiring, and it's not a bad question to ask, what is your claims history for the last 5 to 10 years?
Yeah, no, absolutely, Al. And another thing I'd add to that, if you're most transactions are asset purchases, not mergers. You're buying an asset, you're not buying liabilities. If you have a merger and you're characterizing it as a merger, you can create an issue of fact in the public perception of the transaction that you're accepting liability. So it's important not to call it a merger, not only in the document, but any outside communications from the firm. If it's not a merger, if it's an asset purchase, you don't want to expand as the acquiring firm your liability for prior acts by calling it a merger and then allowing somebody to be able to allege. By calling it a merger, you accepted not only the assets of the acquired firm, but the liabilities. And the liabilities include any errors and omissions that they performed prior to agreeing to sell their practice to you.
Yeah, we've seen simple statements on the website provide some issues. So,
but, so going back to tail coverage, it's important so that if you're retiring and the practice is no longer in exist, you're closing your practice, or your firm is being discontinued because it's being purchased by a larger firm, it's important to know that any claims that may come to fruition based upon services prior to your retirement or leaving the firm or prior to the acquisition are covered. Tail coverages or extended claim reporting coverage is the way to get that type of coverage. So basically, the carrier will step in, and if a claim is made based upon prior services of an entity or practice that no longer exists, they will cover actual claims that come in for a certain amount of time. It could be 1 year, it could be 2 years, it could be 3 years. A lot of states regulate it might be 1 year, 3 year, and 5 years. States can regulate how much time that will be available on the market for this extended reporting period or tail. We always recommend try to get the longest tail because, well, not only is it peace of mind. So if you can get a 5 years, it's 5 years of coverage, but it should be in accordance with the potential longest statute of limitations that's available for somebody to file a accountant's E&O claim against you. Some states it might be 2 years. In some states, with the statute might be told through a repose period or some other reason, and it could go upwards to, I've seen some states have 6 years is a statute of limitations. So it's important to ask your insurance agent, all right, what kind of tail coverage is available and how long is the tail coverage, and then decide what's best for your firm, what's allowed under the state rules, things of that nature. So those are, I think, some important considerations. Very, very complex question. A lot of different scenarios to consider based upon the circumstance.
Yeah. No, this has been great information, very useful. We're going to have to leave it there in the interest of time, but we're going to have you back because I know this is a very complex topic and a very important topic. So we really appreciate your time. This has been a great discussion, and thanks again for joining us today.
Yeah, thanks for having us, Don. We appreciate it.
Thank you for having us.
Thank you. Thanks for listening or watching. For additional information about succession planning, visit our firm management knowledge hub at njcpa.org/hub/firm management.